The Federal Reserve Bank just raised interest rates by 0.75%, which wasn't the surprising part because the thing that investors are paying more attention to was what is the Fed going to do next month and into 2023, and this is what threw investors for a loop. So let me start by talking about what the Fed did, what their statement said, and why that statement confused people, and how then Jerome Powell confused people even more. So at 2 p.m., the Federal Reserve Bank put out a statement which gave their indication of what they want to do with interest rates today and in the future. And what that statement said was that they're going to raise interest rates by 0.75%, which is what they've been doing for the last few months. So another aggressive rate increase. But then they had this one sentence which caused investors and traders to get really excited. And you saw the stock market rally because of this one sentence. It read, "In determining the pace of future rate increases, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects the economic activity and inflation, and economic and financial developments." AKA, the Federal Reserve Bank used to make their decisions on interest rates based off of where inflation is today and where the economy is today. But that sentence changed that. That sentence says that in the future, they're going to make their interest rate decisions not based off of what the data says, but based off of where they think the data is going, based off of where they think inflation is going, based off of where they think the economy is growing, because what it's saying is that raising interest rates has a lag effect on the economy, which is pretty common sense. But what they're saying is now, because they've raised interest rates so much, this cumulative effect, and because it takes time for interest rates to get absorbed into the economy, they're not just going to look at what inflation is. They're going to start thinking about where inflation will be in the future. And based off of where they think inflation will be, that's what they're going to do to adjust interest rates. This got traders and investors very excited because they said, oh, the Fed is pivoting. They're changing course. They're going to ease up on the fight on inflation, because now they're saying that inflation is going to come down, and so they're going to stop raising interest rates, and the fight on inflation is over. It's the beginning of the end of the quantitative tightening. So you saw the markets rally as soon as the statement came out. Well, at 2:30, 30 minutes after the statement came out, that's when Jerome Powell came out, and he then clarified the statement, and he gave his own speech about interest rates and what he expects for the future. And the second sentence was, well, the first sentence was good evening or good afternoon. And then he goes on to say that ongoing rate hikes are appropriate and a significant balance sheet reduction is coming. So the first thing he says, probably because he saw what was going on in the markets, was that they're not done raising interest rates, that they're going to continue raising interest rates, and they're going to continue their fight on inflation. But he did clarify that statement. He said that they are going to now look at the data a little bit differently. They're going to switch from a data-driven approach to a forecasting-driven approach, because before they were just looking at interest rates and comparing that with inflation and the economy and jobs numbers. Now they're going to take the interest rates and they're going to look at the jobs numbers today and where jobs might be in 6 months. They're going to look at inflation today and where inflation might be in 6 months. And they're going to look at that and then start making their interest rate decisions based off of not what the economy is saying today, but based off of where the economy might be in the near future. So that can really impact the way that they raise interest rates, which does mean that they could ease up their fight on inflation sooner, because it takes time for inflation to come down to 2%. And so if they start easing their fight before inflation comes down to 2%, because they think inflation is coming down, well, then that means they could start not raising interest rates even sooner. So that's where investors are excited, because if you stop raising interest rates, well, that's good news for the markets, because now you can borrow money cheaper. It's good news for the housing market. But that doesn't mean that interest rates are coming down, because even Jerome Powell said that they're going to continue raising interest rates, and he even said that it might be appropriate to continue raising interest rates aggressively. He made that clear. He actually said that they're going to continue raising interest rates at least 3 times in his 10-minute speech, because I think he wanted to make it clear that they're not going to stop raising interest rates in December. So continue to expect more interest rate hikes. But then he started talking about the economy and growth and how that's going to impact his decisions. Now, before I go over that, if you do want to stay up to date on what's happening with things like the financial news, with what the Fed is doing and how it impacts the economy, stocks, real estate, crypto, the global economy. We cover this every day in Market Briefs. It's a completely free tool that I created to help you be a better investor, to help you be smarter with what's happening in the financial markets, to help you make better decisions with your money. It's completely free, it's brief, and it's gonna help you understand what's happening in the markets. So if you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. Now, when he talked about the economy, what he said was interesting. First, he talked about growth, and he compared it to growth in 2021. He said that our economy is growing and spending is growing, but nowhere near the rate at which we were in 2021, which really isn't that big of a surprise because in 2021, we still had all the extra money floating around in the economy. We still have a lot of extra money floating around today, just less. And we also have the interest rate hikes. But then he went on to talk about the labor market. And what he said about the labor market is that while we are seeing growth slow, we're seeing the economy slow, we're seeing spending slow down, our job market is still very tight. And he says that we're still seeing a 50-year low in the unemployment rate. And he's saying that it's still too tight of a job market, AKA he wants to cool the job market. Now, if you translate what that means from political terms to real terms, it's we need more layoffs. We need less people to have jobs. Because a tight labor market means everybody has a job, unemployment's low. A loose and cool labor market means unemployment is high. That's what that means. And this is where he keeps talking about we need to pay attention to jobs and compare that to inflation because the Fed has two mandates. Number one is price stability, aka inflation, and number two is maximum employment. So he's looking at these two things. He's looking at employment and he's looking at inflation. And then based off of that, they make a decision on interest rates. Well, now what he's saying is a little bit different. We're going to look at jobs. We're going to look at inflation. And then we're going to look at where jobs are heading and where inflation is heading. And based off of that, we're going to make a decision on interest rates. And so now you have people predicting that this means that they're going to raise interest rates more aggressively, less aggressively. They're going to keep it the same. I mean, everyone's predicting everything. But this is where you can start to see that they are changing course a little bit. And Jerome Powell did make it clear that he wants to continue raising interest rates. We might have another aggressive interest rate hike in December, and that they want to continue raising interest rates probably in the early part of 2023 as well. But they might start changing course, even if inflation doesn't come down significantly, if they think inflation is heading down. Now, inflation doesn't have to go down for them to think that it's heading down. But if they feel like the higher interest rates are going to contribute to a lower inflation, that they will start changing their interest rate hikes, which would then affect the economy. But you also have to understand that even if they stopped raising interest rates today, that it's going to continue to affect the economy. Like they talk about this lag time. I've been talking about it in terms of absorption time. It takes time for higher interest rates to get absorbed into the economy, and higher interest rates are going to affect the economy. Because now if you want to go out and borrow more money, it's going to cost you more money. But for everybody who already has debt, for businesses and people who have debt, that's not a 30-year fixed rate mortgage. Well, eventually your debt is going to readjust because most business debt, non-mortgage debt, is going to readjust every few years. And if you got this debt at 2.5% or 3%, and now it's doubled or more than doubled, well, your cost of servicing that debt is going to increase, which is going to affect the economy. But in addition to that, interest rates are going to continue to go up because that's what the Fed says. Now, of course, they can pivot, but that's what they're saying today. And this is where now you want to pay attention to what the Fed is doing and how they're starting to change course, because this is for the first time, they definitely had a change of course in the way that they're speaking, and that will impact what's happening with interest rates in December and what will happen with interest rates in 2023. And you can see how confused markets were. As soon as Jerome Powell started speaking, markets started falling because he clarified his statements. And so you saw this big whipsaw rally and fall in the markets. So pay attention to what's happening, be educated, be prepared. That way you can make the best decisions for your money. And of course, we keep you updated on Market Briefs. So if you haven't joined yet, make sure you do that.
You have no justification. You can just borrow the money. So what happened? Well, some businesses use their money for good. And some people said, well, I don't have a business. But I wonder if I can look up a registry of businesses and say, ooh, these are some businesses, and just start applying under these business names and say that I need the money.
Wow.
Billions and billions and billions of dollars were stolen. Where did the money go?